This is your brain on risk. This is Mind Over Money, the podcast where Kevin Cook exposes the psychology of investing.
Welcome back to Mind Over Money. I'm Kevin Cook, your field guide and storyteller for the fascinating arena of behavioral economics. Recently, I began a new series called Fast Times at Innovation High, where I'm describing the nature of success and failure in corporations to see what we can learn. Today's episode will focus on the success and failure profiles of two companies, lululemon Athletica and Under Armour. They both reside in the crossover categories of apparel that are variously called sportswear, athleisure, and lifestyle. We know Lulu for its ubiquitous high-end yoga pants, and Under Armour for its cool, high-tech fabrics and fits for pro athletes and weekend warriors. I picked these two iconic brands because of the disparity in their relative performance as companies and as investments. And while I did some homework to find out what gives, I also decided to bring in an observer who has been following these stories closer than I have. Ben Raines is a junior research analyst here at Zacks and the brains behind the Full Court Finance podcast and the Free Lunch video blog. We'll talk to Ben in the second half of today's episode and do an anatomy of success for Lulu's turnaround, as well as an autopsy of UA's failings. And I sometimes call it UA, which was the stock symbol for Under Armour for many years until they created a new class of shares for Kevin Plank. So the new stock symbol is UAA, but I'll sometimes just call it UA. All right, first let me expand on the discussion I started in part one of this series. I mentioned a book we would discuss further, The 4 Disciplines of Execution, by Chris McChesney, Sean Covey, and Jim Hulling. Jim's last name is spelled Hulling. I'll call him Hulling. It was published by Free Press in 2012. You probably recognize at least one name in the trio of authors. Sean Covey is president of Franklin Covey Education and the son of Stephen R. Covey, the author of the 1989 business classic, The 7 Habits of Highly Effective People. Let me read a quote from someone important about the 4 disciplines of execution. It offers more than theories for making strategic organizational change. The authors explain not only the what, but also how effective execution is achieved. They share numerous examples of companies that have done just that, not once, but over and over again. This is a book that every leader should read! And that was from Clayton Christensen, professor, Harvard Business School, and author of The Innovator's Dilemma. We've talked about the late, great Clayton Christensen a few times since he passed in January at the age of 67. In the article version of this podcast on Zacks.com, I'll have the links to past episodes, as well as, I do an article version, not a full transcript, but I include some different things, maybe things I forgot in the podcast, that sort of thing. I always write it afterwards and try and give a rounder picture of what we talked about and what I'm trying to accomplish. Now, before I just list what exactly are the 4 disciplines of execution, I thought it would be good to describe what problems they are attempting to solve. This is from the Franklin Covey website for the book. And they open with this quote: 70% of strategic failures are due to poor execution of leadership. It's rarely for lack of smarts or vision. And that quote is from Ram Charan in a book that he wrote, Execution, the Discipline of Getting Things Done. I'll have to look that one up. I don't know that book. All right, so here's the challenge as the Franklin Covey folks describe it. Do you remember the last major initiative you watched die in your organization? Did it go down with a loud crash? Or was it slowly and quietly suffocated by other competing priorities? By the time it finally disappeared, it's likely no one even noticed. So what happened? When it comes to attaining wildly important organizational goals, the role of the manager in the business execution process is critical. At Franklin Covey, we've studied the topic of execution for several years in thousands of teams and in hundreds of organizations. Our research shows that execution breaks down in 4 major ways. Number 1, managers and work teams don't know the goal. Our research has shown that only 15% of employees actually know their organization's most important goals. Either there are no goals or they have too many goals. Number 2 breakdown. Managers and teams don't know what to do to achieve the goal. Too many people don't know what critical activities provide the greatest leverage to achieving team goals. The third breakdown, they don't keep score. Our research shows that most workers don't know what the key measures of success are, and they don't measure and track the specific behaviors that lead to goal accomplishment. Breakdown number 4, they are not held accountable. Our research shows, and when I say our, this is again from the Franklin Covey website, where the 4 disciplines of execution is basically held and sponsored as part of their curriculum and consulting work for the Fortune 1000. So under lack of accountability, our research shows that fewer than 10% of people meet with their manager at least monthly to discuss their progress on work goals. All right, and we're going to get to the another way of describing the 4 disciplines of execution. But I want to talk about this element that the sort of the overall element that probably is related to all 4 of these challenges and breakdowns, and that's what they call the whirlwind. And so let me read this paragraph. The whirlwind of urgent activity required to keep things running day to day devoured all the time and energy you needed to invest in executing your strategy for tomorrow. And so that's why they're offering the 4 disciplines of execution here. So what this brings to mind is, if you remember, if you ever picked up Stephen Covey's book, The 7 Habits of Highly Effective People, couple of things stand out there. His number 1 habit, I believe, was begin with the end in mind. So that's vision, right? And a lot of leaders have a vision, but then do they turn that into a strategy and execution? The other thing is urgent. Brings to mind the quadrants that Stephen Covey laid out about urgent versus important, and how much time do we all spend in our personal lives or in our businesses really focused on urgent but not important stuff, and that's what can kill. That's not going to kill your business, but if you spend too much time on the urgent and not important, or urgent and important, then you don't have time for what he lines up as quadrant 2, which is, urgent or not urgent but important. So the stuff that takes planning, but it's not urgent, but it's extremely important. All right. So here are the 4 disciplines. Discipline 1, focus on the wildly important. Discipline 2, act on the lead measures. And I'll describe each of these a little bit more. Discipline 3, keeping a compelling scoreboard. Discipline 4, create a cadence of accountability. So those 4 disciplines are addressing those 4 challenges. And the Franklin Covey teams, I guess they've worked with... they said they've worked with hundreds of organizations and 126,000 teams over many years. So they've really had a chance to test this stuff for many years. So I want to read, this was an interview done by Skip Pritchard on his website, skippritchard.com. And he wrote in December of 2012, he interviewed Jim Hulling about the new book. And he titled his interview here, Master the 4 Disciplines of Execution. So I'm just going to read his Skip Pritchard's question for Jim Hulling and then how Jim answered them. So Skip, Jim, for those who aren't familiar with the 4 disciplines, would you walk us through them quickly? And now this is Jim. Discipline 1, the discipline of focus. Extraordinary results can only be achieved when you are clear about what matters most. As simple as this principle may sound, few leaders ever master it. The 4 disciplines of execution teaches why focus is so critical and how to overcome your biggest source of resistance. Discipline 2, the discipline of leverage. With unlimited time and resources, you could accomplish anything. Unfortunately, your challenge is usually the opposite. Accomplish more with less. 4DX, which is their shorthand for the 4 disciplines of execution. 4DX shows leaders where they can find real leverage and how to use it to produce extraordinary results. As a side note here, I just found this sort of clarifies discipline number 2, acting on the lead measures, what he calls the discipline of leverage. The idea is that you can measure all kinds of things in your business, and how close you got to a result, but a lot of that it's lagging. It's based on what happened last week. If you can create and find the lead measures that tell you what kind of progress you're making, so you know if you're getting close to your goal, that can make a ton of difference. It'd be like a game where you had to get to 50 points, and you were constantly monitoring, points gained versus points lost. Oh, we're up to 22. Oh, we're up to 25. Oh, we're back down to 23. Whatever's creating that gain and loss as you move forward, letting you know how close you're getting to your goal. So this requires you to identify and act on the measures that are predictive of reaching your goal. All right, discipline number 3 is keeping a compelling scoreboard, and Jim Hulling calls that the discipline of engagement. You have the authority to make things happen, but you want more than that. You want the performance that only passion and engagement can produce. 4DX enables leaders to rise from authority-driven compliance to passion-driven commitment in themselves and the people they lead. And an additional summary thought here is that this discipline requires you to create a player scoreboard so that members of the team can easily tell whether they are winning or losing. So that might be a scoreboard for the lead measures that'll tell you how your progress is going towards the goal, and then also what you've accomplished in the past that you're building on. All right, discipline 4 is create a cadence of accountability, and here's how Jim Hulling describes that. The discipline of accountability. No matter how brilliant your plan or how important your goal, nothing will happen until you follow through with consistent action. 4DX brings the practices that drive accountability and follow through, despite a whirlwind of competing priorities. There again, the whirlwind is the stuff that distracts you, the day-to-day chaos of running an organization. And here's the afterthought that sort of summarizes this last discipline. And he turns it in, he uses the word commitment now. The discipline of commitment requires you to hold regularly scheduled team meetings where members make and keep commitments to each other to execute on the wildly important goal. And that's actually what they call the first discipline, is focus on the wildly important. So you're identifying wildly important goals for the organization, and that sort of forces you to choose, right? You could have 10 or 20 goals, but if you don't focus on the ones that are wildly important to the organization, then you're just getting turned around in the whirlwind, so to speak. All right, as we wrap up the first half of today's episode, which is the second part of Fast Times at Innovation High, I want to leave you with a taste of another book that I just rediscovered about decision making. It's called Decision Traps: The 10 Barriers to Brilliant Decision Making and How to Overcome Them, by J. Edward Russo and Paul J.H. Shoemaker. And what's interesting about this book is that this is from the late 80s, and I think most people don't even know it exists. What's great about it, though, is that these guys are laying out, their work on decision making, and they were students of Kahneman and Tversky and Herbert Simon's work, and they actually knew Richard Thaler. I think one of the gentlemen was from the University of Chicago, Paul Shoemaker, at the time, was associate professor of decision sciences and policy in the Graduate School of Business at the University of Chicago. And Russo is a professor of marketing and behavioral science at Cornell. So they both, studied and probably knew Daniel Kahneman. Maybe they knew Amos Tversky before he passed. And they both knew Richard Thaler because they cite him in here. So this book looks like a lot of fun, and I never read it, but I have referenced it before, and it's interesting to see that. Last week we talked about another decision-making book from, it was from like 2012 or 13. And, all this work has been done by people who paid attention to what Kahneman and Tversky taught us about behavioral biases and things that get in the way of better decision-making. But this book was around in the late 80s, just like Stephen Covey's book, The 7 Habits of Highly Effective People. I'm flipping through this now, and I see I've got a lot of notes in here of stuff that stood out to me. I'm trying to find their 10 barriers because I wanted to read those to you. Oh, here they are. So here are the most decision makers commit the same kinds of errors. And I'll just read these 10 to you really quick. Plunging in, frame blindness, lack of frame control, overconfidence in your judgment, short-sighted shortcuts, shooting from the hip, group failure, fooling yourself about feedback, not keeping track, and failure to audit your decision process. So it's some great topics there. We'll dive into this next week. But right now we got to get ready to bring in Ben Rains and talk about Lululemon versus Under Armour and what kind of execution or lack thereof is going on in those two iconic brands. I'll be back faster than you can spell overconfidence. And we're back to dive into the strategies and execution of Lululemon versus Under Armour. Before we bring in our guest, Ben Rains, to help us analyze these two exciting athleisure brands, let me set the table. And remember, we're not trying to figure out which stock to buy now, although you will get a lot of valuable information that could aid that decision. What I'm focusing on is how the companies and their stocks got where they are because of what management did in the fickle consumer apparel market for the past 5 years. So Lululemon the stock has been on a tear, making all-time highs recently. I was just about to pull up a chart, and I didn't yet. But and Under Armour is the exact opposite. They just reported and in February, and the stock fell again when analysts were trying to figure out, hey, can this thing hold on to $20 a share? UAA is the symbol now, by the way. Even a month ago, I thought it was still UA, but they did they created a new class of shares, and so now the official stock symbol for the company is UAA. But just looking at Lululemon here, we got to all-time highs of $265, it looks like, just in February. Before the market decided to take a big breather or crash, depending on how you look at it. Yeah, to like 266, Lululemon got to. And that was, on the heels of a really steady, couple-year advance here. Let me just pull up a weekly chart so I make sure I can tell you how far Lulu has come. So looking back here at late 2017, you could have bought it for Christmas in late 2017 at under $70 a share, 65 bucks. So quite the monster advance for Lululemon. And so we're going to look at what they did right, but we're also going to have to I think it'll help to look at what things were going wrong. I mean, they had to get rid of the founder. They had to kick him out of the company for various reasons. Then when they got a CEO, That didn't work out for very long, a new CEO, and had to replace that person. Then they had their the whole see-through scandal, or debacle, as it were, where they went a little too thin on a new fabric innovation for the yoga pants, and women were discovering, and men, that they were see-through to an extent, and a lot of people weren't happy with that. Some people were, some people weren't. So, how did they survive that? And then when you look at Under Armour, so let's see where Under Armour stock has been. Let me punch in UAA here on a couple year chart, and this is a stock got up into the high 20s as recently as last year. So last summer we were looking at a $27, $28 stock, and has just cratered down to $10 after their last earnings report. Things weren't so good. Let me look at the one of the analyst reports here. Somebody who lowered their price target. Stifel Nicholas had to lower their price target from 27 down to 20 on February 11th after this earnings report. And basically, the company just delivered guidance that sales guidance and earnings guidance that the street didn't like. For instance, the company's guidance was a midpoint of sales of $5.14 billion and earnings per share of 12 cents, but that was against the consensus on Wall Street among analysts of $5.5 billion and 46 cents. So a big wipeout to the top line sales and the bottom line earnings in the fiscal year 2020 guidance from Under Armour. So that's why the stock collapsed here from basically, the high teens. So I'm looking at it. Yeah. The week of February 10th, right before as they reported, shares were as high as 20 during that week, and are now trading under $12 here. And what else did I want to mention about the great things going on in Lulu? I think that's about it. Under Armour, the whole reason I'm doing this is I want to find out what has gone right and gone wrong at each company to have them where they are. Oh, and one of my takes here is if you just looked at a certain valuation metric that is pretty popular among us at Zacks here, and that's price to sales. Price to earnings ratios can be all over the place, and one of the reasons that makes them extremely variable is what companies can do with accounting to change that bottom line EPS number. Everything from buying their stock back to having one-off items and that kind of thing. But the sales are the sales at the top line, and those are hard. You can't do any counting tricks with the sales. So that's why we looked at is what is the enterprise value of the company, like the market cap versus the sales. And we call it, so in a real simple way, we call that price to sales. If you just looked at that, you've got Under Armour with over $5 billion in sales, trading at a $5 billion market cap. So that's a price to sales ratio of 1, and that you want that number low. So that's attractive for a growth company. And let me just double check that valuation here. Yeah, $5 billion for Under Armour UAA. Whereas Lululemon, the market cap is $26 billion is the market cap for Lululemon. Now let me get their most recent forward sales estimates so that I'm giving you the most accurate information here. So Lululemon is their forward sales projection for next year is $4.5 billion. So if the stock has a market capitalization of $26 billion versus $4.5 billion of projected sales for next year, it's trading, over 5 times sales, basically 6 times sales. So that's expensive. So Under Armour's cheaper on a valuation base than Lululemon. You would think, hey, let's buy. Why is Lulu so expensive? Well, let's bring in Ben Raines now to help us figure this all out. Ben, thanks for joining me on the show today.
Thanks for having me, Kevin.
All right, so talk to me about the mistakes and hiccups that Lulu had, in the past 5 years and how they recovered. What do you think they did? First of all, what were the problems, and then how did they recover from them? What did they do right?
I think the problems weren't necessarily on the fact that they weren't making money. The revenues were consistently growing, consistently in the high or low teens. They ran into some issues, as you mentioned, with their founder, Chip Wilson, had to step away from the company in 2015 after he made some remarks about maybe who should not be wearing their clothing, their athleisure clothing that's often very tight-fitting. We won't get into all of that. So he stepped away in 2015 after starting the company all the way back in 1998. And then they had hovered sort of sideways from 2012 till about 2017, as you mentioned. Now they've gone on a massive run, and this includes changing the CEO now twice at this point. The second guy who took over actually had to step away for other reasons that they didn't really want to get into as well. But all of that said, they've continued to expand in this athleisure business you've talked about, and they've continued to grow, and they really aren't even in Asia yet, which is crazy. They're not that far into Europe yet, and they're really starting to grow. They have this new, what they call their Power of Three plan to drive growth over the next 5 years as they roll out more menswear business, more things that aren't just strictly yoga pants and athleisure is the basic business. And what I would say the biggest difference between why Lululemon and Under Armour sort of diverged at a certain point over the last several years is that it sounds simple, but it's really hard to cultivate cool. And Under Armour has certainly gone in the wrong direction on that side. And Lululemon has just skyrocketed in its quote cool and sort of brand awareness where you want to see that little infinity style looking logo everywhere.
But wait a minute. Under Armour has The Rock.
Yeah, right?
And Steph Curry too, right?
And I think that speaks directly to the problem, in my opinion.
Okay.
So Under Armour stock was at all-time highs near around $50 per share, and this was in the fall of 2015.
Okay.
And that happened to be right after Steph Curry and the Golden State Warriors won the NBA championship that summer in 2015. The Curry ones had come out that past winter for the first time, so it was the first time they're rolling out the Steph Curry basketball shoe, and he's changed the NBA. He's a small guy shooting threes, and all the young kids want to be Steph Curry, and it's probably ruining people's basketball careers because they're trying to take 30-foot threes at 10 years old. But so that was when you started seeing articles about, is Under Armour going to overtake Nike, blah, 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 blah. And basketball shoes don't really sell if they're only worn on the basketball court. Like, that's just not a big enough market. So the Currys were selling for young kids, but you weren't seeing adults buying Steph Curry shoes and wearing them, say, walking around. And then you mentioned The Rock as well. And that gets back to what Under Armour did so well to begin with. They had those tight-fitting shirts that were supposed to wick away sweat. You could wear it in the winter. You could wear it in the summer. That's how they came to prominence, those Protect Those House commercials you saw everywhere, that tight-fitting gear. And now that Project Rock is doing so well for them. But the problem is it's geared towards real hardcore like workout junkies, and that's just not a big enough market.
Okay.
When you think about it, I mean, and I hate to use this example, we were talking about this beforehand, but we live in Chicago. I take the L to work. Chicago's the third biggest city in America. I see people wearing Nike, Adidas, Lululemon all the time, every day of the week. I never see anyone wearing Under Armour stuff anywhere.
Yeah.
And this is at the gym, outside of the gym. And I know it's anecdotal, but I think it goes a really long way.
It does. It's the old Peter Lynch philosophy of investing. Buy what you know. Kind of buy what you see, too. If you're not seeing the volume just in your everyday, if you see regular volume of people wearing stuff, on the train or in your commute in a big city like Chicago, and, you either see it or you don't. I think that weighs a lot. So I want to come back to some things with Lulu, but we'll stick here on Under Armour right now. Yeah, I'm looking at the price chart going back to 2015, and I see this. The stock was up in the 50s. So, Yeah, that was absurd. Like anybody thought that Under Armour was all of a sudden going to put a dent in Nike's business. I mean, maybe they could put a little dent, but not a big dent. But what you're telling me is they couldn't even turn it into a real business, right? Like, is the shoe business at Under Armour dead or alive?
I would say the shoe business is dead for the most part, or not going to grow.
Okay.
Unless they make a big change. And obviously, as I said, basketball shoes don't sell necessarily if they're going to be for the basketball court.
Right. The formula that is anybody who knows anything about, Nike and Jordans and stuff like that, we're going back into the 90s when middle school kids had to have them, right? So that's what grew their sales, was that everybody had to have them.
Yeah, I mean, Nike, those shoes have become ubiquitous for anybody just wearing Nike shoes, walking around on a Saturday or even at night to a restaurant or something like that. I mean, so I pulled up 2019's top selling sneakers in America.
Okay.
Nike had, quick glance, 8 of them. Adidas, or Nike had 6. Converse had 1, and they own Converse. Adidas had 2, and Vans had 1. Under Armour was clearly nowhere to be found. In all of those shoes, I don't want to read through all of them, but none of those are gym shoes, quote unquote. These aren't shoes that you would see people wearing to the gym. The number one selling shoe was the Nike Air Max, which is kind of just like a trainer that looks like it's from the 80s that you just see people walking around in. And those are what are selling. And Under Armour just isn't selling shoes. It's making up about 20% of their business in 2019, while apparel is about 65%. And for reference, Nike's like the exact opposite of that. Shoes are about 65% of their business, and apparel is like 20%.
Okay. And speaking of apparel, you said with Under Armour that they've got this niche market with guys who want to be like The Rock, hitting the gym. And sounds like you're suggesting that's probably not a big enough market because if they're not wearing it outside of the gym, the way you do with athleisure and apparel, then your sales aren't going to be big enough.
Yeah, and I think that 2015 was that like inflection point where people thought they had risen to prominence on that kind of workout, really hardcore for the gym or playing sports, and they thought this Steph Curry is going to translate to off the court, and he's going to be maybe the next LeBron, Michael Jordan kind of guy. And sure, on the basketball court he is, but that just hasn't translated, and it's kind of gone. Their sales plateaued in 2016. They were up like 20% then. They had gone up like 20% for years straight.
Yeah.
And now they're going slipping completely.
Even 2016 and 2017 were, they weren't bad years for sales growth. I think I was looking at the chart earlier. But yeah, really plateaued here in 18, 19. And now it sounds like they're trying to hold on to $5 billion for this year.
Yeah, because I think our estimates are calling for their sales to drop 3% in 2020. Yeah. And the big part of their business is still North America, which makes sense. They're a North American-based company. They haven't been around as long as Nike, obviously, anywhere close to that. North America is accounting for about 70% of sales, and those sales have fallen for 3 straight years. So that is not a good sign when your biggest business that's accounting for 70% of revenue has declined for 3 straight years.
You're losing the home court there.
Yeah, and I think also when it comes down to it, a sport you do want to be in, and obviously it's a little hard in America, I think still sometimes people don't think of it, is soccer. And Under Armour's not in soccer really at all. And so internationally, if you're not in the World Cup, if you're not in the Premier League, you're just not going to be visible. I mean, Adidas and Nike and Puma actually dominate soccer globally.
Okay. Even more than Adidas, huh?
Yeah, well, Nike and Adidas are kind of 1 and 2. Okay. And then Puma's sort of that third tier player as well.
All right. And to clarify here on Under Armour sales, they came into, they had a real strong 15 and 16, vertical 45% growth. And then things just leveled off as they come into 17, 18, 19. And, so that's why the stock is getting beaten down and investors and analysts don't see the growth there.
Yeah, they're I think people were trying to convince themselves that growth would translate. What Adidas and Nike and other companies have been able to do is that off the court look to be everywhere. And it just hasn't worked out yet. So obviously, maybe they could have a turnaround, but I think they really took their shot. They paid ASAP Rocky, who's a rapper / musician, to be a brand ambassador. That has totally fizzled out. I haven't seen anything about that. The last big athlete they signed was Joel Embiid, who plays for the 76ers, a 7-foot guy who's a great basketball player, but big men don't sell basketball shoes. How many young kids are like, oh, I want to buy that 7-footer guy who stands under the basket?
Yeah, he's not the guy who's flying across the paint.
And I mean, they have big names: Jordan Spieth, the golfer; Tom Brady, the greatest quarterback ever, is an Under Armour athlete. But no football cleats aren't moving the needle.
Gotcha.
I mean, just so that's it's hard.
So they've got some innovation to do. Speaking of innovation, you were talking about. I want to show some of the headlines for Lulu, and then I want to ask you about that 3-pronged strategy you said they had coming in. So these are some of the headlines for Lululemon. This is from March of 2015 on Reuters. Lululemon customers say selection at core of sales turnaround. So it seemed like there was a sales turnaround happening in 2015 there. When they embarrassingly recalled their signature yoga pants for being too sheer. Let's see. I found another good article here. Oh, this was an interesting one. And this is from thestreet.com, but it's profiling a interview that the CEO did on CNBC with Sarah Eisen in July of 2016. And what was interesting is that here's a positive statement from the CEO. If you look at the trend and take athleisure out and look at the lifestyle of being athletic and mindful, that trend is going to continue to grow for a long, long time. But then in the interview, I guess the CEO, and this was the CEO before last name of Pot Devon. I'm not sure if I'm pronouncing that right. The trend of the lifestyle being athletic will stay. Okay, we got that. But here's the thing that she said. Is this a man or woman, Pot Devon?
I believe it was a man.
Yeah, okay.
Yeah.
He said the athleisure bubble will pop. So in 2016, the then CEO of Lululemon was saying the athleisure bubble would pop. And if that would have been true, we probably wouldn't be having this conversation about Lululemon at 265. Did the athleisure bubble pop or did it get bigger?
It certainly didn't pop. And I mean, I think I understand what he's saying. And when we talk about their kind of the power of 3 thing they're doing, it speaks to a little bit what he was talking about. And I think he was more trying to say we're a more diversified company than just yoga pants. But it certainly doesn't look good when the CEO of a giant athleisure company is saying the bubble is going to pop on our business.
Yeah.
But I would say that's hardly been the case.
Okay. Obviously.
I mean, everyone from Target to Walmart are trying to start their own little individual in-house athleisure brands. I mean, you go into a Target, you see athleisure everywhere, a Walmart everywhere.
Yeah.
Gap started their own athleisure brand. All these companies are doing it.
Just to get some perspective, I asked somebody here around Zach's, who is a big fan of the Lulu brand and the yoga pants. You know, what's the deal? What's the appeal? And she said, I said, is it all about the quality? It's like, did the quality of the pants and the other clothing, was that the key to survival for Lulu? And she said, well, yeah. She said, and you just love them. And, you'll pay $120 for them, not just for the quality, but also for that brand label.
Yeah, it's sort of like why people are buying iPhones when there's a lot of cheaper options that might be just as good. It's sort of that brand cachet that's slowly built over time.
Yeah, and that idea of the quality. So what else is Lulu working on?
So this is what they've been talking about for the last year. So in April of 2019, and a lot of this had been happening already. So in April 2019, they rolled out what they're calling their, quote, Power of 3 plan to drive growth for the next 5 years. And this includes 3 basic things. They're going to try to double the size of their menswear business by 2023, more than double the size of its digital revenues by 2023, and quadruple its international revenues by 2023.
Wow. So men's, online, and then going for the international.
Yeah.
That seems like a pretty good mega strategy.
Yeah, and it's proving to work so far. I mean, a lot of their business is growing outside of that athleisure. As we mentioned, they're doing what they call sort of more work-appropriate office-style clothing. I would picture it and you could look it up, obviously. Think of something maybe you would see a man wear on a golf course. A polo, pants that are kind of a crossover between a little athletic, but they look nice enough to wear to work. A guy who actually sits right by me at our office, Dan LeBeau, he wears a lot of Under Armour clothes to work. And if you didn't notice it, you couldn't tell that they're quote unquote lululemon clothing, because it's polos, it's pants. They also have outerwear. They're trying to compete in that clothing or the outerwear coats, sort of trying to get people who don't necessarily want to spend $1,000 on their Canada Goose jacket in North Face, but they have outerwear. They're doing self-care, so deodorant, stuff like that. They've even tried what they're calling a loyalty program. So you pay like $128 a year. You get either a pair of pants or shorts, fitness classes, and then like free shipping, expedited shipping. They're trying that out. And actually in Chicago they rolled out what they call an experiential store this past summer. I've been into it. It's on North Avenue, right off of the river. Giant 2-story store with a yoga studio in there, a place to eat, take classes.
So it sounds like they're exploring all dimensions of the lifestyle brand.
Totally.
Right? It's not just what you can pick up off the shelf and put on. It's the experience, the classes.
They host marathons now, or 5K, stuff like that. So they're in, I think, back to what you were saying, that CEO said about the athleisure bubble popping, that they're hedging their bets, not necessarily hedging their bets, but they're transitioning into this broader company that isn't just known for tight-fitting yoga pants for women.
Right.
Because that's, as we talked about with Under Armour, that's not a big enough market to sustain growth for a long period of time.
So in this series, Fast Times at Innovation High, this is episode 2 of, and by the way, there'll be an article version on Zax.com where I'll have all the links and whatnot. I'm focused on how companies take a strategy and then execute it, because every quarter, it's earnings season 4 times a year around here, and every quarter we get the company report cards. What did you do? Did you follow your plan? Did you execute? And so. And there's always this question of, is one company just luckier than another? Did they just have the right product at the right time, and that's how they got rich? And when you look at these two companies, it could have gone either way. The management team at Lulu may not have survived, and but they did have a good core product. They just needed to get the right people in there. Would you say that at Under Armour that with the right management team, they could have innovated and still be growing?
Yeah, I mean, it's kind of hard to say because, sort of as we mentioned, these companies sort of took diverging paths. You could say maybe around 2015, 16, 17-ish. And 2015 is when the founder of Lululemon stepped away from the business that he had run for a very long time, made it into a global giant. He stepped away 2015.
He's like, a great concept. Yeah. We'll take it from here, though, because we don't need the sexist comments.
And Kevin Plank just stepped down this past October, and he started it in his grandma's basement or something like that in the 90s.
I love that story,
and it's great. But at a certain point, maybe it would have been better for him to step away when they were at their peak and they needed to transition. When they got this Steph Curry and all the momentum seemed to be behind them, maybe he should have taken the chance to step away then. And it's easy for me to say step away from the company you started when it seems like it's only going to go to the sky. But they certainly, that transition where they were going to be that next maybe third tier below Adidas and below Nike, it seemed like they botched it. And I don't know the inner workings of the company, but I've read Wall Street Journal articles that it had a stranger, like small company culture still, but they were a big company at that point.
Yeah.
And there was things where they were using company credit cards to go to strip clubs, and this is all information out there. This is not speculation. So, and he was maybe too close with people who were in upper management that were his buddies, and it wasn't how a big publicly traded company 20 years into their business should be running at that point.
Yeah, good point.
It seems like.
You know what? When you talk about what's the three-pronged strategy again from
The power of three.
The power of three. Okay. So, and I remember what they are. It's more menswear online and go international. Now, as an example of a company laying out a strategy, whether it's a 5-year plan or whatever, it could all just be talk. It could be like, oh, yeah, we drew up this strategic plan, and if there's no execution, we're going to find out. But it seems like, they have people who can turn that stuff into plans, and that's what I talked about in the first half of this episode was, who are the companies who do it, and how is it done? How do you take this strategic vision and then, turn it into a 3-year plan and break that down, and it's 1 year and it's 3 months and all the details that have to go along with that. The companies who execute are the ones who win. So I'm excited to see how this unfolds for them, and if they can, sort of avoid the athleisure bubble pop, as it were. And we'll be looking at Under Armour too. I mean, the stock is cheap on a dollar basis if you just wanted to say, oh, I can buy it at $11, but it's also cheap on a valuation basis where it's only trading one-time sales. The thing is are those sales going to keep slipping or flatline? I mean, right now it was flatlining at $5.5 billion. Now they're slipping down to $5.1 billion. So they've got a challenge on their hands. If you were asked to consult Kevin Plank and the team at Under Armour, what would you say their best business opportunities are?
Obviously, it's very hard to say. I mean, it's simple enough. All of the things that they sell now, I would say if maybe they had a different brand logo on it, it would do better. I think that the brand Under Armour has never gotten the recognition from the people that they would hope it would have had to do what Lululemon has done and transition into cities like New York and Paris and Tokyo, and where you see people wearing this out and about who are, and I hate to use the word considered cool, but I mean people you see in groups of people that all happen to be wearing, say, the same Nike shoes, or a group of women all wearing the same Lululemon leggings. The only people I see wearing the same Under Armour shoes are maybe 10-year-olds. Like, that's just not going to drive sales long term.
Right. So it is possible that they, that they strike gold with the right rapper or athlete, and then you do have this sort of craze. Because if you can get one craze going with a product, whether it's a shirt or a shoe or whatever, and it. It's like a video going viral, sort of like. I mean, when I say video, I don't mean any of our videos, because we do that every other month anyway. I'm saying like when a new song or a rapper all of a sudden gets something to go viral, and then all of a sudden on the scene, like I was looking at you ever heard of this rapper Doja Cat?
No.
Oh my gosh. She's this 25-year-old sensation now, but she just came out of nowhere. But like if you could do that with an item of clothing or something, and all of a sudden, it's the craze in Tokyo or Shanghai or whatever, then maybe you can do it again, and you get that momentum going, and people, because what do people buy? Like the kids who buy the shoes and the clothes, it's usually it's not their money, right?
Exactly, yeah, it's their parents' money,
and it's the experience. Oh, they want to be seen with that at school, and then it sort of creates that buzz.
Yeah, and I think that's why the stock price hit $50 in 2015. It was Steph Curry. Yeah. He is going to be it. And it sounds bad to say, but that seemed like maybe that was their chance. He seemed like this transcendent superstar on and off the court. And if that wasn't able to move the needle in the positive direction, it's hard to say what will. And I don't want to say that they don't have global reach, because I like to use like a proxy of kind of youth-focused culture of Instagram followers. I know for companies, Nike blows everyone away.
Right.
in terms of these athletic company brands. They have 103 million followers on Instagram, owned by Facebook. So 103. Lululemon has 3.1. To put it in reference,
3.1 million. Okay,
compared to 103 for Nike.
Okay,
and then Under Armour has 8. So Under Armour double the size of Lululemon on this global facing social network. So it's not that Under Armour has no reach and no one knows about it. It just might be that it's not reaching the right people at the right time right now.
Yeah, it's not creating the buzz for a lot of things, and I'm actually impressed at their sales. I'm like, how if they failed at shoes and then they're in this niche market with weightlifters, and I know there's more, but I mean they still do $5 billion in sales.
Yeah,
so I need to take a closer look at that. It might be. Is there a lot of golf stuff? Is that pretty heavy?
I know Spieth does well for them. Polos, pants, golf shoes. That's a pricey business. People who golf tend to have more money they're willing to spend. But I was reading recently, one of the problems Under Armour does run into is that they have a hard time convincing people to buy stuff at full price. A lot of they have a hard they're trying to be in discount places, maybe like a Kohl's or something, where then it's hard to translate into being a higher end brand. Like you're not going to see Lululemon in a discount store.
That's a good story. That happened with a retail brand that I liked a few years ago. God, I can't even think of the name of it now.
There you go, right?
Yeah, exactly. Is they diluted the brand by allowing things to like slip into the the outlet malls and the discounters and flooded the market basically. And so, that's a bad road to go down. I want to read you this one thing. I found a really cool article I just searched like Under Armour failures, and on Google what came up was an article from the Motley Fool, Under Armour's 6 biggest blunders. And you've already covered most of them. This is from January of 2018. But the author, Leo Sun, his 6th one was kind of interesting, and this may or may not be a blunder according to you, but I'll read it. Number 6 was believing that it's a tech company. Kevin Plank also repeatedly emphasized the idea that Under Armour is a tech company instead of a traditional footwear and apparel maker. That's why it purchased various mobile apps, developed its own fitness and shopping app, and produced connected footwear, wearables, and other devices, which seems like a great idea, right? Let's plug into, the biometrics and all that. But it hasn't worked, huh?
Yeah, and it is funny when you read through their income statement and you see, I don't remember the exact category they call it, but it's either wearables or something to do with technology. And it's like, why is this in Under Armour's income statement next to apparel and footwear and licensing agreements and all of that? And that just doesn't seem to work. I mean, what is the point of you having a fitness tracking?
Yeah, app? I don't know. I like it, and not that I'm know what I'm doing in apparel, but it seems like it's the right direction to go. Is people they want it personalized and they want data. This is the age of data. It's the age of personalization. It's track your stats, track your heartbeat, track your steps, and that if you could plug that into your clothing and have it work. But maybe it doesn't work because you can't wash it, or I don't know.
I think a company, this would be successful if they were going in the direction that Lululemon's going in, and they were growing sales now, and they were going in seemingly the quote-unquote right direction. That now that sales have plateaued, and there are all these other, you could look on your iPhone app store and find 100 different fitness tracking apps you could download for free. So what is Under Armour doing to differentiate itself? And especially when its brand doesn't seem to have much cachet these days, why are you downloading Under Armour's fitness tracking app? Okay. Especially if you don't wear Under Armour shoes or gear. So, I mean, it's the right idea, but it seems maybe it was made at the wrong time, or it was made when they thought it was going to be everyone buying their Steph Currys and tracking how much they're running on the basketball court, and it just hasn't worked out that way.
I know for an older guy like me, I would if it could be easy for me to work out and always see my heart rate, and I don't like wearing a watch, so I'm not going to wear an Apple Watch, but if it was built into my clothing and I could check my heart rate or blood pressure, really easily, I would do it. So maybe that's a few years away yet. Maybe the technology hasn't evolved to make it that simple.
Yeah, that built-in fitness tracking, all of that. That'll be in 10 years. All the clothes we'll wear will tell you everything.
Right.
That preventative medicine angle that will eventually be cool. But I don't know. It doesn't seem like it's quite there just yet.
All right, Ben, I think we've accomplished our mission here. I wanted to look at these two companies, what's happened in the past 5 years to make one, worth $26 billion and one worth only $5 billion. And even though the smaller one seems a better value, where the growth is, where the appeal is. So it'll be interesting. I'd love to look at this with you again in, a few quarters, see what's transpired, see how Lulu is executing on their strategy, and see if Under Armour's come up with any new innovations to reinvigorate their sales.
100%, yeah.
Yeah, all right. That was Ben Rains, analyst here at Zacks, who's followed these two companies pretty closely and helped me break down strategy and execution or lack thereof in a couple of big apparel brands, which, these are fickle consumer businesses to begin with. So it's not, I don't think it's easy. We've seen Gap has struggled for years, and they saw an opportunity to jump in and copy the success of Lulu with yoga pants with their Athleta brand. I'll be really rooting for Under Armour and Kevin Plank, though, to come up with the innovations that are going to drive the future of that company for the next 10 years. Because I know it's going to be around, and the stock will be a buy at some point. So we'll check in again in a few quarters. Thanks for joining me on Mind Over Money.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.